There's a fear that when AI starts to materially disrupt, potentially have once-in-a-generation interruption of white-collar markets and knowledge workers, the Fed may want to get ahead of that labor market potential significant downturn, because when the labor market turns, it turns very fast and very hard, and it's very hard to reverse.
This may be the first time the Fed's really been front-footed on innovation, not just leading in like a rate cycle, but trying to truly lead at transforming that system. Hello, everybody, and welcome to Bits and Bips, exploring how crypto and macro collide one basis point at a time. So I'm Austin Campbell, self-described and recovering grouchy fixed income trader and professor at NYU Stern. I'm your moderator for this show because, to be honest, we drew lots. Somebody has to keep Chris under control, and I lost, so I have to do it. With me today are Chris Perkins, part of the Citi Crypto Mafia, president of Coin Fund, and somebody who I can assure you has some heat on some macro topics in investing. We also have Ram Ahluwalia. Ram is the founder of Lumina Wealth and is also joining us from Money 2020, so took time out from partying and gambling to chat with us. Thank you, Ram. And then finally today, our guest, Joseph Chalom, the CEO of SharpLink, NASDAQ ticker SBET, the former head of digital asset strategy at BlackRock for 5 years with an over 20-year career at BlackRock, and friend of Chris Perkins, probably the most dangerous thing on the list that I've said. Today, we're going to be talking about a number of different things, including Fed decisions, the inflation backdrop, payments, U.S. and China trade deal optimism, a bunch of stablecoin news around Citi, Coinbase, the first yen stablecoin, JPMorgan increasing their presence in crypto, the CZ pardon, and a new CFTC chair being named. We're optimists around here. We'll get to all of these.
Binance is the world's #1 crypto exchange, trusted by over 290 million users. With industry-leading liquidity, security, and a wide range of digital asset products, Binance is the place to buy, sell, trade, and earn crypto. Download Binance today to get started. Mantle is pioneering blockchain for banking, a revolutionary new category at the intersection of TradFi and Web3. Follow Mantle_official to learn more.
So without further ado, let's get started with the Fed and inflation. So for those who are unfamiliar, every so often a group called the Federal Open Market Committee meets. This is 12 people, 7 Fed governors and presidents from regional banks across the United States. They're the ones who vote on interest rates. They're meeting this week. They're expected to cut interest rates by 25 basis points. But this is not the only thing they do. These are also the leaders of the Federal Reserve and have many other topics on their mind. So starting with the macro backdrop, we have a cooling employment market. Unemployment claims are rising. Today, the news is out that Amazon might be laying off up to 30,000 people per Reuters. Inflation remains above trend at 3%, above the 2% target, but not catastrophically so. And according to Deutsche Bank economists, Powell is likely to keep options open and not pre-commit to a particular action through year end. So starting there, Ram, let me throw it to you. What are the implications of what's going on with the Fed, and what should we expect from the market?
Sure. So first off, I would have characterized the backdrop differently, right? I'll share my screen. We'll look at initial claims. These are just seasonal fluctuations that happen as the economy transitions from a summer economy to a back-to-school economy. We've seen this last 3 years in a row. There's a spike in initial claims. There's some softness in the labor market. People call for the Fed to cut. And then you see unexpected economic strength in Q4. That's going to happen again this year, I believe. Against that backdrop, you have productivity growth, increasingly driven by AI levels we haven't seen since the late 90s. You got unemployment rate at 4.1%. Sky's not falling. We're seeing strong earnings growth again from the regional banks last week, the mega banks before that, and the S&P and the indices just hit all-time highs today at 6,800. The Fed doesn't need to cut. They didn't need to cut last year as well. When they cut last year, the 10-year went out, stock markets ramped. It's okay. I'm not going to fight the Fed. The fact that the Fed is cutting into Goldilocks, this is Goldilocks. I think I'm the only one saying this is a Goldilocks economy. Objectively, look at the data. People just don't feel like it's Goldilocks in their head. They feel bad because of headlines and geopolitical risk, and they don't like what Trump is doing with the East Wing. But fundamentally, this is Goldilocks. So when that happens, though, you should be owning risk assets. And so, look at initial claims. This is initial claims. You can see there's some noisiness around the data. Don't forget, like, data series like the non-farm payrolls, which was supposed to come out the first Friday of the month, which didn't because there's a shutdown. It's extremely noisy. Like, the confidence interval is like 100,000 plus or minus. It's just noise. And the most valuable, reliable data subject to audit is company earnings data. Company earnings data. And every week during earnings season, my team and I go through the companies that report to the day, and we compile highlights in our newsletter. We don't see weakness. You don't see weakness. So there's company specific weakness. Okay, Tesla missed on new order. That's idiosyncratic, but credit is good. Economy's fine. Earnings is good. CapEx is strong. So that's the story. This is Goldilocks.
I would take the other side of that in that you saw Fed Reserve Governor Chris Walker in July dissent and focus on the fact that, yes, looking backwards, the labor markets have been actually really robust and resilient. The American economy is consumer driven, but there's a fear that when AI starts to materially disrupt, potentially have once in a generation interruption of white collar markets and knowledge workers, the Fed may want to get ahead of that labor market potential significant downturn, because when the labor market turns, it turns very fast and very hard, and it's very hard to reverse. I think over the last period, as long as we've remembered, the Fed has prioritized price stability, obviously their primary concern, and they've been very, very hawkish. But the labor market is coming to a moment that matters. Anecdotally, lots of companies are slowing down hiring. And, anecdotally, lots of people I know with really, really good educational backgrounds, graduating top universities, are having a very hard time finding white collar jobs. And I would bet that they're more worried about that hard shift on labor and the dislocation coming from AI. That is just harder to reverse. So while you look backwards, it's been Goldilocks. You can make an argument there's a labor demand cliff coming.
I don't know. From my perspective, I was just checking out Polymarket, and now I can access it on the World app for the first time, which is pretty cool. We're investors in World, not in Polymarket, but Polymarkets make it clear that the rates are coming down, and I think we know that that's absolutely going to happen. This is a government that's very focused on expanding our GDP, both real and nominal, and they will do whatever it takes to do so. They're also looking to put assets in the hands of retail. Like Trump opened up this retail account for kids that are born now, and we're trying to make sure that they're sharing in those assets. So that's what this government's thinking about. I had the opportunity to go to the payments conference at the Federal Reserve last week, and I couldn't believe what I heard. Started with Chris Waller, Governor Chris Waller, who I have an incredible amount of respect for, got up on the stage and he's like, everybody, it's time to embrace the disruption. And like to hear that coming out of a Fed governor who is positioned potentially to be the chair, and I'd be thrilled if he is nuts. He talked about opening a skinny account. And what is this Fed trying to do? They're trying to make sure that we lead, that we innovate. Stablecoins are everywhere. I sat next to him at a private lunch, and he's just like, I recognized the opportunity with stablecoins 4 years ago. No one was listening to me at the time. But now they're listening, and we're going to be all in on this. And so you have an entire government that's focusing on growing the pie, growing the GDP. I don't know if they're going to be successful or not. It feels like we're in a very good macro environment for asset prices, particularly in crypto going into the end of the year, because of the de-risking and the stimulus that they're looking to inject.
I mean, I'll go a step further than Ram and jokingly call this the check market, which is to say you can kind of take whatever you want from the picture that's being painted right now. If you feel like there's room to cut, it's because of the employment story that Joseph just told and fears of disruption in this market due to AI displacing many forms of labor and also maybe some of the impact around geopolitics. Like certainly there's a narrative there. If you want to be hawkish, you've got inflation sort of above trend. And you're looking at that and saying, wait, we need to be concerned with that one. I think we need to be hiking. And so one of the things that I would expect is that it's going to take a dislocation in one of those two things to cause anybody currently at the Fed to change their mind as from where they currently hold it. So I think the current path of cutting will continue because the votes seem to be there for that. Ram, I agree with you. That's very good for risk assets right now in the current backdrop. But to me, the thing we're watching for to change this path is, does unemployment really crank up? Because that would be a sign that many of the hawks are going to flip. Or does inflation really crank up, which would be a sign that many of the doves are going to flip? But in the current state, I think we're just kind of living where we are. The thing to me that's news out of the Fed, and I'm going to pile on with Chris here, I was at the Chicago Federal Reserve Payment Symposium a little bit back, and the number one and number two topics of a symposium that historically has been around instant payments were stablecoins and AI, right? We were looking at a full-scale modernization, not just of U.S. banking rails, but an acknowledgement that the line between retail payments, business-to-business payments, settlement, and global money transfer is now blurring. And at the same time, a lot of both optimism and concerns about what AI is going to do. There was one presentation that was on screen that only afterwards was revealed that, no, that was entirely fake. This was completely AI generated. And even though the real person it was based on is sitting right there and it looks identical, none of that was real. So there are a lot of questions around how are we going to handle these things. I think, and Ram and Joseph, I'd be curious to hear your view. This may be the first time the Fed's really been front-footed on innovation, not just leading in like a rate cycle, but trying to truly lead at transforming that system.
I 100% agree. I've never seen in my life a regulatory climate that's been this permissive and this constructive. Fed Governor Waller, to Chris's point, Fed Governor Bowman about a month or two ago, SEC Chair Paul Atkins. And you've got also, of course, Bessent leading the charge here. This is extraordinary. I mean, this is a bigger deal than Glass-Steagall. I was trying to think back in history, like when's the last time we saw something? This is a bigger deal than Glass-Steagall. And then before Glass-Steagall, well, you have to go back decades. It's actually been more regulation, not less, since then. So I agree. I'm not worried about this labor market dislocation. Labor market's clear in a competitive free market, open economy, and labor becomes more productive with AI. We're seeing that in measured higher productivity growth, and employers are going to hoard labor. They don't cut when their earnings are going up. They can actually make more money with talent when commingling that talent with labor. So this is a good story. Labor growth is slowing down because you have less immigration. That's it. So the supply of labor is going down. Therefore, you'll see job creation come in at a more measured pace. It's a normal thing.
All right. So moving on to our next topic, to get to global money flows and modernization, the world's first yen stablecoin launches in Japan. So JPYC became the first fully backed stablecoin denominated in yen. It's backed by JGBs and domestic savings. The stated goal there is to issue 10 trillion yen, so roughly 66 billion in current numbers, over 3 years. No transaction fees initially. It's monetizing via the interest on the reserves. All three of Japan's mega banks appear to be jointly involved in the launch. The Bank of Japan is saying stablecoins could partially replace bank deposits and global payments on the back of this. But there, to be honest, is uncertainty around domestic adoption. Global use is definitely targeted for trade flows. And also, I want to say in particular, congratulations to Naoto-san and the JFSA, as well as Ushida-san and the previous team. There are many people there who have been working on clearing the path for this for a long time. As Ram said earlier, it's a remarkable regulatory environment as we've turned the corner here. So I want to start with Joseph. I believe you have some views here. What do you think the impact of this is going to be?
It's interesting. If you take a look back 6 months, the narrative coming from Washington and globally was the U.S. was at risk of potentially losing its reserve dollar status. You had China and others threatening not to buy U.S. treasuries. So clearly, Secretary Bessent, the Trump administration, believe that U.S. dominance in crypto markets, U.S. dominance in tokenized assets, if backed by U.S. denominated stablecoins, is a double positive. One is you'll have more and more of the world's financial transactions, not just global trade, denominated in stablecoins like Tether, USDC, and others that are overwhelmingly USD based. But second, people forget every single stablecoin needs to be backed by a US Treasury. And if you look at the likes of Tether and Circle, I think collectively they're a top 15 creditor of the US government. So if you can believe that the world is tokenizing all financial assets, they're going to be paid for and transacted in stablecoins, which are US dollar denominated. And that creates massive demand for US Treasuries. This is a win-win-win for the US. It's a win for Washington. And I just spent 3 weeks in Asia and the UK, and there's real fear that these local currencies are going to lose their vaulted status. So I'm not surprised that Japan is doing this. I am surprised that Europe and the UK seems to be very, very far behind in solving this. But smart move by the Japanese government. And I think there's enough global trade and enough intra-company trade in Japan to support this, what you call a $60 to $100 billion stablecoin effort. And I do think it'll be successful. I just think the US dominated stablecoins are going to actually bring the US dollar back to strong reserve status in global financial services. So this is a win for Washington, and you're going to see others trying to chip away and preserve their own reserve status.
I'll chime in. Joseph, I agree with you. I think that stablecoins are going to, we've talked about this before, really extend US dollar reach. It's pretty ironic. Like when I was in Wall Street and I was running derivatives businesses, yen used to scare the bejesus out of me because I was uncollateralized for so long. I'd have to wait for the stuff to come in and settle. And I was like, gosh, if I could settle this stuff quick, where is the yen stablecoin? Because that is going to give me the most utility of anything. Because I would pay out, I'd be waiting because my client, of course, would make me just take that risk. And I hated that risk. So with stablecoins, that goes away. We call that risk in Wall Street, we call it Herstatt risk. And the reason why we call it Herstatt risk is because in 1974, there was this German bank called Herstatt, and it blew up because it paid out and it didn't receive, and it went bankrupt. And it's ironic because after that, the BIS, which sets global capital rules for banks, they set up BCBS, which helped address that issue. And what the irony is that you have the BIS now that's been really anti-stablecoins, even though like these stablecoins are literally going to solve the problem that brought them into existence. We're going to eliminate settlement risk. So I'm excited about that. I'm even more excited about the FX markets. FX is a $7.5 trillion a day market. You can't trade FX if you only have dollars. Like this gets me super excited. I want to see that type of real-time trading. I think it's going to be great for the economy. It's going to be great for the Japanese. Look, Joseph, you're also right. The Europeans are behind. Why are they behind? I think it's because of the way they calibrated the regulatory capital. If you have to reserve 2 or 3% for every single euro, and you're only making 2 or 3% on that float, it's really hard to scale. I think that jurisdiction is going to have to figure it out pretty quick. Otherwise, they're going to be left behind.
Do you think, Chris, that the stablecoin market replaces or disrupts the FX market? Like, do these converge? I thought it was a great, call out on Herstatt risk.
Yeah, of course. Like we talked about this, I think, in the past. Where let's just talk about the equity markets, right? I have a choice. Do I buy an equity like as I do today, or do I buy a tokenized equity? If I'm a fiduciary, I have to buy the tokenized equity, assuming liquidity stays the same, right? Why? Because if something happens on a Saturday and there's a risk issue, I have to manage my risk. How do I settle them? I settle that in stable coins, right? So all things being equal, the tokenized product is a better product. FX, the same. Do I want to have an FX product that settles T+2, or do I want to have an FX product that settles real time? If I'm a fiduciary, what do I want? It's just a better product. So again, like I used to run the largest FXPB in the world. I was managing that Herstatt risk, and people say, oh, CLS, we solved everything. CLS doesn't handle every currency. Austin's shaking his head. I want to hear his take. But these innovations drive better markets. And I'm sure the CEO of SharpLink is going to talk about where much of that, many of those stablecoins live today. But yeah, it's a better market. It's a better system. And like the fact that some regulators are pushing back, especially the guys sitting in their ivory tower, the BIS, saying this is going to be a problem. I think they have to get back to first principles. Like stop trying to defend and create moats. Move forward and understand the risk mitigation that you achieve through stables.
Yeah, I was shaking my head about CLS because CLS, although useful, is a very limited purpose entity. Chris, like you and I have both been derivatives traders, right? And like there are many forms of settlement that need to happen, some of which are 24/7 across global venues, potentially in different currencies, where CLS is at best a very small part of what's going on. And to your point about everything being on chain and preferring the tokenized version, if I can have, call it a 24/7 global omni ledger, Joseph, if you know one of those, let us know, right? Where I can put everything on it and then be able to transact, I'm going to be able to do things like clear our global interest rate derivative framework 24/7, eliminate like the double margining problem. These are very real structural financial improvements. And to pile on with what Joseph was saying, one, I do think this is a huge win for the dollar. Dollar stablecoins are the leader. As more things move on chain, that reinforces their power. But I would also say I think it's going to be a big win for anybody who's a fast follower. So I think Japan has done something very smart here. You want to get into this game. You want your currency to be used for things like trade settlement. You want it to be used on chain as collateral. You want to start building those reps early. And to their credit, the JFSA has been early to a lot of things in crypto. Like I will remind people, they were one of the best at regulating exchanges. So FTX Japan is one of the few entities that survived. So there is a track record here, but moving early is going to matter. If I was a smaller country with limited state capacity, had no intentions to do a stablecoin, I would be existentially worried even about the continued existence of my currency right now.
Yeah, and I think it goes beyond currency. People forget that most assets today trade on a venue-specific basis. Like if your stock is listed on NASDAQ, you're trading on NASDAQ. If you're on Deutsche Börse, you're trading on Deutsche Börse. When you end up getting a global settlement layer that's decentralized, and I'll posit an ETH and tokenization maxi, that's going to reap real repercussions on global capital markets in Europe and the UK and areas that are already struggling to list innovative companies and retain innovative companies. And when you start getting that decentralized settlement layer where pretty much anything can trade with anything programmatically, composably across borders, and I know there's a lot of regulatory hurdles, I think it's going to wreak havoc on those secondary and tertiary markets who've relied on the venue moat to keep capital markets in their jurisdictions and in their native currencies. And I think Europe and the UK will be the biggest losers in this regard.
This also makes like tokens like Ethereum, Solana, the layer ones where these assets live, very strategic suddenly, right? Like if you have trillions of dollars of stable coins living on Ethereum or layer one of your choice, how can you not as a government have an arsenal in that? Like what commodity is more strategic? Like, yeah, I guess oil is very strategic for sure, but this becomes a core important strategic commodity that you have to have.
All right. On that note, we do have to flip to an ad, but then we're going to come back and argue more about stablecoins.
Binance is the world's #1 crypto exchange, trusted by over 290 million users globally. With world-class liquidity, security, and a wide portfolio of digital asset products, Binance makes crypto easy for everyone. Whether you're new to crypto or a professional, Binance offers a simple user experience. Learn with Binance Academy, browse hundreds of tokens, and track your portfolio on an easy-to-use dashboard. For experienced users, Binance Pro provides industry-leading services and bespoke trading products. With some of the lowest fees and deepest liquidity in the market, it's no wonder over 290 million users choose Binance for everything crypto. Buy, sell, trade, earn, live crypto. Download Binance today and begin your journey into the future of finance. Disclaimer: Binance is not available in certain countries, including the US. Check its terms for more information. Binance.com/en/terms. Mantle leads the establishment of blockchain for banking as the next frontier. UR is the access layer that transforms Mantle Network into a purpose-built vertical platform, the blockchain for banking, that enables financial services on-chain. UR unifies and vertically aligns Mantle's focus on payments, trading, and assets. MI4, METH protocol, functions FBTC, supported by developer grants, ecosystem incentives, and the industry-leading distribution platform through the UR app, Reward Station, and Bybit launch pool. All economic activity within UR will be captured by Mantle Network to further drive value to token holders and establish its significance in blockchain for banking. Follow Mantle_official to learn more.
So let's keep talking about stablecoins. Chris, our former employer, Citi, has announced that they're partnering with Coinbase to test stablecoins for cross-border payments for corporate clients. The goal there being to simplify crypto to fiat conversions to speed up settlement times and targeting what they said was 24/7 institutional demand for programmable payments. What impact do you think it's going to have that the big banks are now getting into this game?
I'm happy for my old colleagues at Citi to be leaning forward. If you know anything about Citi, the crown jewel is something called TTS. It's Treasury and Trade System. I think I'll murder it, but it's the payments business of the world. They pay DoD, they pay the world, and they've leveraged. When you become a managing director there, they'll pull you aside and say, "It's the network. It's the network. We've been here for hundreds of years because it's the network." And the network they refer to in their moat is the correspondent banking system. And so I'm really happy that they're now leaning forward and saying, well, wait a second, we need to be able to settle and pay in real time using this new technology. I wish them all the luck. But there's also this other debate going on, and this was at the Fed, and this is the debate around tokenized bank deposits. And a lot of banks are like, no. Tokenized bank deposits are better. They pay yield. We're all about tokenized bank deposits. And like, Mike, I've been trying to get my head around this thing. I don't understand it. I don't understand the utility. I understand money markets. I understand stable coins, these tokenized bank deposits. I was literally sitting next to Waller at lunch, and Governor Waller, I'm like, explain. And I guess the consensus at the Fed Payment Center was like, this is going to be an internal tool for the banks to move assets through their ecosystem. Maybe that's it. But I'm still struggling with that one personally. I wish I was a little smarter on that subject. But look, great news for Citi. Congrats to them. And it's, again, it's a better product. Like, you don't have a choice. So good luck.
I think it is in sharp contrast with JPMorgan, who've really been leaning into those bank deposits. And Chris, they don't pay interest. And it might be that JPMorgan has a big enough walled garden. They have, one of the is the largest bank. They believe crossing and moving across accounts and netting with tokenized deposits is better for them in the long run. Citi obviously is going in a different strategic direction, I think a more forward direction. So I do think it's worth contrasting with what you've seen at JP Morgan to date. But Ram, I think I might have interrupted you.
No, I think that was great. Briefly, Citi invested in BVNK, which is a Stripe competitor focused on merchant acquiring. That was a very thoughtful move. They partnered with Coinbase on this. So the incumbents are responding swiftly. The CEO talked about the stablecoin initiative on the earnings call. This is a CEO-led objective. I wouldn't underestimate Citibank around this as much as I'd love to see them disrupted. Actually, I'm long Citi, have been for a while around this. And I think, Austin, you and I spoke around this a few months ago. You thought that some of the big banks would have a natural advantage here. I think that's true. Would love to get your take on this.
I think, one, the banks are going to be forced to evolve. As Chris said, it's just a better product, right? Like, take international wires, which are kind of a broken space right now. I have T+5 and huge fees versus a couple of seconds to send Chris or Joseph or Ram money on chain. right? The just commercial weight of that improvement will drag the banks along kicking and screaming, or they'll die, right? This is a sort of like the internet hits book selling moment for payments in that regard. Now, on the form factor, I've been a little bit of a skeptic around tokenized deposits being the ultimate settlement thing, because I think we kind of got to bank deposits being used for payments at scale accidentally, right? If you rewind to like the 1970s, the majority of payments being made were made in cash, and cards were only starting to come onto the scene, right? Like banks were not integral to like buying coffee. And as a result, I think they've sort of stumbled into a digital monopoly that was not deserved. But the problem with bank deposits is these are incredibly not fungible items, right? Like maybe a little while ago, we'd feel very differently about deposits at JPMorgan versus deposits at Silicon Valley Bank, as an example. And so when the deposits themselves are not fungible, because to move between banks, you're moving credit risk and balance sheet assets around, it does beg for a simpler solution. And you end up at sort of a least common denominator of acceptable, which is like a box full of T-bills or overnight lending secured by treasuries, which everybody will take. And so I think what we may end up is a slightly different layer cake in the future, which is to say banks probably should start thinking right now about taking well-designed stablecoins as deposits themselves.
I think we've been speaking to the institutional and commercial side of these banks, but there's a massive generational shift where, especially outside the US, there are more and more young people who are about to inherit tens of trillions of dollars from our parents and from us, who are more likely, especially outside the US, to have a crypto wallet than they are to have a deposit checking account at Citibank. And I think on the retail side, you're going to see money movement almost entirely denominated in crypto to crypto wallet movement, instantaneous, low gas fees, easy to handle. I think we've been more focused on this idea of commercial and institutional banking. But I think on the retail side, you're going to see lots of people who've never walked into a bank, who may not even have an ATM. They get their credit relative to the collateral in their crypto wallet. And I think the crypto wallet is just going to end up being the form factor for how people store and move money on the retail side, especially outside the US and in developing countries.
I mean, I'm going to pile in there and say I've got some students who have bank accounts who have never walked into a bank branch, Joseph, right? Like they've got SoFi or something like that, where everything was done online already. And like, if you ask them, their like personal nightmare is, what do you mean I have to go somewhere physically in person to do it? Like, this is great. I've got a phone right here. Right. And so I think this digital nativeness, right, of people who grew up with the technology, who are used to using it, who understand it, who trust it, not say the current 75-year-olds who are like, I don't know about this PayPal thing, I can't open the phone up and take the money out, is going to be a generational shift that forces people in this direction. I don't know if it's just stable coins. Like, honestly, I think for retail, obscuring the difference of what they're using and just making it easy is probably the winning play. But to your point, being interoperable with everything brings you there.
There's a post-retail demographic that's coming on the scene too. It's called AI agents. I'm serious. Like, that's the next one after this, right? And like, you just saw a pretty interesting release with something called X402 standard that allows now agents to pay themselves micropayment to micropayment. So like, that's the other part of this economy that we're barely touching the surface, and there's innovations every single day. But I imagine at some point in our lifetimes, those micropayments are going to probably outpace the human ones that we're talking about.
Yeah, Chris, I'm going to geek out here for your audience.
Let's do it.
Which is read ERC 8004, this idea of trusted, trustless agents who understand boundaries and registries. I think it's going to be sooner than we all think that there's going to be some sort of digital wallet twin that understands our preferences, our risk tolerance, can help build portfolios for us, can help move money, will just do payments for behind the scenes. And over time, I think that's going to start melding not only with your wallet, but your prediction markets. And I think there's a world that's coming much faster than we expect. And it's agentic money, a digital twin of your wallet. And I'm not exaggerating. I think most of us are going to have that in the second half of 2026.
Somebody asked me a question today. How are they governed? How do we govern these agents? It's pretty tough because like we always talk in DeFi. In a way, it's simple, even though our politicians haven't figured it out yet. It's like leave the technology out of it. We're gonna make sure that we enforce activities, institutions, individuals, behaviors and activities. Go after it. Leave the tech out of it. So like, what do you do when you have like the technology and behaviors in a vertical? How do you govern it? Like that's going to be. Somebody asked me today. I didn't have a good answer.
I think you're right on the mark, though, Chris. You're going to see these agents. You're going to have the keep my fridge stocked agent, keep me fed agent. It goes and orders Uber Eats. It knows my calendar, which is another agent. You're going to have the agent that does the send $200 to that person in Manila, call it foreign remittances agent. You're going to have agent that does subscription optimization. I'm probably paying for things I'm not actually using. So I agree. I think you're going to have all these micro agents, which will have approvals and spend limit controls and some kind of orchestration agent, probably run by a big tech company or OpenAI. I hope it's not a big tech company. I'm just saying that's probably the base case. It's still exciting times, still early in the use case adoption.
All right, I'm going to bring this back around to the other side of the bank thing, since Chris was talking about strategic assets earlier as well. Chris, JPMorgan has stated that they're going to start accepting Bitcoin and ETH as loan collateral, allowing institutional clients to pledge them by the end of 2025. Sounds like they'll be using a third-party custodian to avoid directly handling the crypto, but it expands on some of the prior moves to accept crypto-linked ETFs as collateral and JPMorgan's own efforts in the payments space. This is something of a symbolic shift. As we all know, Jamie Dimon has been one of the biggest Bitcoin haters out there, but now his firm is starting to operate in this space. So, Chris, how real is this? And then, Joseph, I want to hear from you. What do you think the implications are of adding ETH to that list as well?
I really want to hear from Joseph. I mean, borrow lend seems to be like one of the first ports of call for like utility and really unlocking, the value of these assets. Like we know that crypto, it's private property in the internet for the first time. It has value. How do you unlock that value? By borrowing and loaning against it, right? It's a super important, just table stakes, foundational layer of finance. We saw, I think Cantor Fitzgerald's been jumping into it. They were early. The fact that a prudentially regulated bank is now saying, wait a second, we're going to do this as well. It really caught my attention because when I was in the bank, like we have these like regulatory capital rules where they treat different assets differently. And it's really nerdy stuff, but like you could barely start any business, even if you wanted to with crypto, because you had to hold like almost 100% collateral capital against it. It's really hard to make a profitable business. And so like my question is are things changing? Because I haven't heard that. And then number two, if you're a DAT guy, like Joseph, right now you have an equity. The equity rules are much more favorable when it comes to borrow lend than the native rules. So like, as I start thinking about the unlocked, the potential of DATs like SBET, I mean, to me, this is like, wow, this is just so much more utility than some of the native assets. But I'm really curious to hear what Joseph has to say.
Yeah, I think this is a watershed moment. What's interesting is for at least the last 5 years, banks have not been able to touch Bitcoin or ETH. But what they've been doing is market making the ETFs that we launched at BlackRock and Franklin Templeton and Fidelity. They've been in this room. They just haven't been able to touch it. I think it's a major signal for both Bitcoin and ETH. I think it's legitimizing them, and I think there's an investment thesis for people to have it in their portfolios. There's a reason why SharpLink, we're the second largest ETH DAT, has gathered basically over the summer 3.5 billion of ETH, as basically the highest powered money for the next generation of finance. And I'm talking about supporting trillions of stablecoins, RWA, which is at the early stage. But I think the second message here is that everyone in crypto is looking for growth. And I think this decision plus the wipeout in the perps market is basically going to start really differentiating between quality growth assets and non-quality growth assets. And you have this DAT phenomenon where basically Bitcoin, ETH, and Solana are probably 99.9% of all DAT assets because they have the most utility and the most promise. But I do think this is going to be a further differentiation between quality crypto assets, which have a use case, a business model, a mega theme, and those that just basically are being used for either trading purposes or speculation purposes. And I think this is another watershed moment. I would just remind people that on October 14th, when BlackRock was issuing its earnings, Larry made a statement, and he did in his annual letter last year, that all assets will be tokenized. Most of it is happening on Ethereum, over 80%. And to date, there's only been about 30 billion of tokenized assets, and this has been happening over 7-8 years. Wait till you see the largest financial firms in the world not only tokenize all equities, but tokenize the largest ETFs. You're going to see a boom for ETH and the Ethereum network. And that's why we're very bullish in gathering as much of this as we can at its current prices. But I think you're going to see a massive differentiation between stablecoins, Bitcoin, and ETH, and everything else.
Yeah, no, I'll add to that. I agree. It's a watershed moment. You have a couple $1 trillion that's now eligible for bank financing. So banks are going to lend against this. They're going to have high net worth and ultra high net worth investors and OGs in Bitcoin and Ethereum, and soon will be Solana too, that now can get liquidity in their holdings without having to sell and pay tax. Yeah. Less sell pressure. You're going to have, you're seeing offerings like Rain Card. Rain Card has raised a couple $100 million. They allow crypto natives to walk around, spend against their crypto assets on chain, and live a life like Mark Zuckerberg. And Mark Zuckerberg isn't selling meta stock. He's borrowing at a 30% loan to value from a big bank against the value of his holdings. So yeah, this is a big deal. And what's going to also happen is more of these assets are going to enter capital markets and the banking system, which is incredibly ironic, especially in the wake of Choke Point 2.0, where they were debanked, ostracized, and JPMorgan would cancel accounts. If you disclosed you had crypto, you could get canceled. This was just 2 years ago. Now you're getting benefits in the form of liquidity if you custody your assets at a bank or if you contribute your capital in kind to an ETF.
So yeah, and Ram, wait till we see creative ways not only to pledge your Bitcoin and ETH as collateral, maybe you're going to be able to soon pledge staked ETH as collateral in some manner and then earn yield while you're using the asset as collateral. That is extremely productive and also differentiated over Bitcoin. I mean, we'll see if that happens.
That is essentially the liquid staking argument, right? Like I recently helped some folks write a comment letter on that for the SEC, where it's like you could almost have the best of both worlds here, right? You have an asset that is productive, contributing to the governance of a network, generating some sort of return for the holders, and is liquid at the same time. The funny part is like people act like this is an alien thing, but we have a whole market where you can like hold the asset and earn something and then trade it right now. It's called the bond market, right? So like this is not an alien concept for people, but I think as Ram was saying, all of this is now breaking to the mainstream in a way that's going to be transformative for the assets that achieve it.
One of the most bullish things as well is that the traditional finance hasn't caught up. Like if you look at accounting standards, for example, on LSTs, they're intangible assets. So if you're holding those on your balance sheet, you have to mark them down to the lowest level over the reporting period. As these things get sorted, and they're going to, because we've got a government that wants innovation to happen, we have so many unlocks that are coming along, that are on the horizon, that are inevitable. And that's a very bullish place to be.
Well, speaking of potentially being available in the U.S. at some point, the founder of Binance, CZ, was pardoned by Donald Trump. As a reminder for everybody, CZ pled guilty. It was a plea bargain, not a trial, to one count of willfully violating the Bank Secrecy Act by failing to maintain an effective anti-money laundering program at Binance. He served 4 months in federal prison for this. And as a longtime banking person myself, I will point out this is not unique to the crypto industry. There are countless banks that have engaged in similar conduct. And even though in the Binance case, there were allegations that CZ knew about this, again, the same has been true in the banking space. So if you were to look at the history of like TD Bank, Deutsche Bank, Citibank, HSBC, many others, I'm not sort of picking and choosing favorites. This is a common problem. And in all of those cases, while there were large fines, people largely did not go to jail. So Trump granted a full pardon to CZ after Binance had already paid a $4.3 billion fine as part of the settlement. The White House framed the pardon as support for crypto innovation and stated that CZ had been unfairly targeted. CZ said that he was grateful and pledges to help make America, quote, the capital of crypto. The critics on the left would say this points to a possible conflict of interest given Binance's ties to some Trump-linked projects. But I want to start with, what do we make of this? What do we think of CZ's pardon? What does it augur for Binance and the regulatory landscape?
Look, I think a lot of people misread CZ. I know I did, and I think now he will go down in history as one of the most incredible fintech entrepreneurs of all time. And somehow he's not on the Forbes list, which makes no sense. He should be like top 10. He owns one of the most valuable exchanges globally. I think you actually hit the nail on the head, Austin. There's a disparate treatment here between him and what others did. Now, there was an early exchange that was founded by these Microsoft dropouts, and they were bigger than Coinbase back in the day. I'm trying to remember the name of it. But they also had BSA, AML infractions. They just shut down due to that. So I think in the case of CZ, was the case with those entrepreneurs too, they were focused on building a business and just did not understand the compliance obligations that go with launching a business that moves money and touches the banking system. I think there's an interesting question around, is there a political angle here? Was there any donation made? We got to ask ourselves that question, right? Is there any potential link between the World Liberty Financial stablecoin and CZ and Binance? Binance, the best exchange for distribution, but they already have their own native stablecoin. Will we see an announcement there? If we did, that would look a bit funny, right? But I don't know, Austin, what's your take on this? Do you think there's a political angle, or?
Well, I'll pause you to say Binance no longer has their own stablecoin as the guy who used to manage the reserve for that before it was shut down.
DFS put an end to that.
Yeah, which I'll maintain. By the way, that was an own goal, both politically and like a geopolitical level for the United States. Joseph was talking earlier about the importance of stablecoins for the dollar. And here we had one of the fastest growing stablecoins onshore. It was a top 3 stablecoin. It was in New York. It had reserves that were fully sufficient, fully disclosed. By the way, I know this because I was managing them. And then when they had to liquidate it, they took it from 23.5 billion to 0. And it did absolutely nothing to the market. And everybody got their money back, right? Like, we had it. And probably the biggest beneficiary of shutting that down is Tether, right? Which is offshore and not nearly as transparent. So I think that was a huge mistake. And then it just leads to this overwhelming sort of pressure by, at the time, the Biden administration on crypto in ways that were fundamentally unfair. Like, I've been critical of CZ's pardon, not because I think CZ shouldn't have been pardoned, but because I kind of think it's a half measure without stepping back and asking, why are we doing this disparate treatment thing? Like, what is going on with the Bank Secrecy Act that it's okay for HSBC to launder tens of billions of dollars for the cartels? And if you read that case, there were allegations like literally having boxes specifically made for the exact size of the teller windows to like shoot them through there, right? And nobody raising red flags about this. Nobody went to jail. But of course, in crypto, you go to jail. I think there needs to be bigger and deeper reform to prevent these issues. And also, Ram, to your point, when people are starting up a business, helping to educate them and get them up to speed on what is going on with anti-money laundering compliance and why that matters, rather than just chopping people's head off with an axe immediately.
Right. No, so the coin they had was Binance USD, was shut down under 2.0 with Paxos. That gap is still there. Couldn't they do a deal with World Liberty Financial, let's say?
I will speak here on this one and say, I'm not sure Binance wants a single specific stable coin going forward. They may now see that as a single point of failure problem. And this is an own goal geopolitically by the U.S. We could have had a U.S. stable coin on there. Joseph, you've been trying to butt in. I'm sorry.
No, I'm less focused on the pardon angle as I am on the implications, which is I would anticipate weakly held opinion that in the first half of next year, you're going to see Binance US reinvigorate. My sense is you're going to get a lot of advertising on this podcast and it'll no longer have the disclaimer not available in all jurisdictions. The real interesting thing is, will they find some way to link the order books? Because the order book overseas dwarfs anything you would see in a US crypto exchange. And if they're able to find ways to link order books legitimately, I'm not suggesting they would do it illegitimately, you're going to see a lot of pressure on US and other crypto exchanges who've had that regulatory moat and barrier. And I would anticipate they will be very aggressive to take advantage of this pardon and the clean slate. It's harder to do when you start seeing turnover at the SEC and CFTC later in administration. I would assume they're going to be extremely aggressive. And I think that'll put a lot of pressure on other participants here.
Yeah, I guess I'll just chime in. So I think it's really important to distinguish CeFi from DeFi. The DeFi argument is completely different. This is technology, and it's the way people use it that needs to be regulated. Binance is a CeFi. It's a centralized entity, and it really should be following the laws that apply to it. Full stop. Austin, love your take. The thing that really got me back in the day was when I saw that, I think it was a CFTC court document that said, hey, you could barely even, buy an AK-47 with that $600 or whatever it was. Like, that set me off like to the moon. I got so angry because I was in Iraq and I was on the receiving end of those AK-47s, and it's not fun. And it's like totally inexcusable to have that type of approach. When you have buddies who were killed next to you, like that is no bueno. And so long story short, but you go back to 2004, we didn't have crypto. It wasn't going to be invented for another 4 or 5 years. So, then you start thinking and you're like, wait a second, before I joined crypto full time, I really had to come to Jesus with myself. And I'm like, listen, I cannot be involved in any kind of money laundering. It's so core to what I think about. I went into the OFAC website. I looked at every single fine. And to your point, Austin, it was all banks. And I'm like, what is going on here? So like, we really got to step back. This is much bigger. We have much bigger issues than going after a CEO. And like, why aren't the other CEOs thrown in jail? Double standard for sure.
Yeah, I would say in many ways, I regard Binance as a symptom of the problem rather than the problem itself, if we're thinking about what's going on. And by the way, back to the value of a blockchain, like, consider how compliance works in the traditional financial system, right? Like, let's say Ram owns a bank and he's got a bunch of customers and he's trying to figure out, can I do business with these customers? Well, what he's got available to him is basically the information those customers have given him, what he can verify in government records and other sources like that, and then the transaction data that he's got. So if we have a chain of events, right, like to construct something that actually happens in the market where Ram's got a customer who sends money to a bank that Chris owns, and Chris's customer receives it, they spend money with a card that goes to a business that Joseph is servicing, and then that business pays a dividend to an owner in a bank that, say, I own, and then that owner is the one who sends money to a terrorist organization. How the heck would any of you guys have known about it? You wouldn't. Everybody is kind of looking at their own feet with a flashlight. And then we're expecting this to be an effective situation for policing money laundering. In many ways, Chris, you raised part of the answer, which is when you get to decentralized systems that have a lot more metadata attached to them, even if it's pseudonymous, right? Like, I'm not saying dox everybody here. That's crazy. But the pattern recognition gets much better. And as you unmask the bad guys, you can start to see flows. And if you were to have, I don't know, something we've discussed earlier, a US stablecoin with freeze and seize capabilities, now you might have the ability to reach in there and take that money out. Well, again, having created a system where in the first place, we didn't have to KYC everybody to make that work. So to me, sort of the thing that I would hope to see come out of this, and I'm going to say so far we haven't seen much indication of it, which I find disappointing with the current administration, is that if we really want to move in this direction, we can build a much better platform to stop the actual crime part of this from happening. Because one end of the disparate treatment, Chris, as you said, is exactly that CZ was punished, bank executives were not. Profoundly unfair. But the other problem is we have one system where we're constantly critiquing it for money laundering, which is crypto, and another where far more of that is probably occurring, which is banks, and we just seem to be ignoring it, which I personally find to be a bit of a problem. All right, Chris doesn't want to dunk on that, which is a good sign. So final quick topic here, back actually to what Joseph was just saying. about the importance of the government and their operations here. So there was a whole brouhaha around Brian Quinten's becoming CFTC chair and his nomination being opposed by certain figures in the crypto space that led to it being withdrawn. But I have good news. Our long national nightmare is finally over. We have a nominee for the CFTC chair, and it's Michael Selig. He was previously the head of the SEC Crypto Task Force, was also at the CFTC with then Commissioner and Chair Giancarlo, and he has pledged previously to help make the United States the crypto capital of the world. Also had a long career as a private lawyer, was involved with the Digital Dollar Project. Like Chris, I'll say you and I both know Mike and think very highly of him, but I want to punt to the group, maybe actually starting with Joseph on this one. How important is it to have a pro-crypto CFTC chair for enacting some of the things that we want to as an industry?
Very simple, two reactions. One is bullish. This is really, really important. You're not going to have that internecine warfare that we've seen between the SEC and the CFTC. They can essentially coordinate. But at the same time, I also think we need there to be, beyond regulatory clarity, you still need to have supervision, because I think this industry has proven they can't necessarily always police themselves. So I do think you need to have clarity. You have to have a pro-crypto leader, but you can't abdicate the responsibility to enforce those clear laws. I think what's more important to me personally, and this is a personal opinion, is to have a separation between the SEC and CFTC. The idea that the SEC chairman would run both, I don't think would be the greatest precedent, unless we want to have a unitary regulator like you have in other jurisdictions. So clearly bullish, and I'm also glad we have a precedent of having two independent chairmen for both the SEC and CFTC.
The one criticism I've heard of Mike Selig is that they said, oh, he's too close, sidecar of Chairman Atkins. I take real offense to that. I mean, Joseph, I totally appreciate we've got two different agencies here with two different remits, but they're focused on the same principles, and they have to be coordinated. Like, we want them to be coordinated. They used to have a joint CFTC SEC committee that was like supposed to come together to address novel issues. It was disbanded in 2014. Like, what the hell? And so, like, I don't think that should be a criticism. I think that should be an incredible tailwind and something that he should underscore during his confirmation hearings. I'm a person who's going to work across agencies to get this thing right, because it's really hard. It's really complex. I mean, I've met with both Chairman Atkins and Mike Selig in the same room, talking about the same principles. I'm excited about the path forward. This is a missing link. I think the big question now is, how fast can we get them confirmed? Who are going to be the other commissioners? And then let's get to work, guys. We're running out of time. We got a lot to do.
I'll pile in to say I don't think those issues are even unique specifically to just crypto, right? Like, call it discoordination between the SEC and the CFTC has been a problem writ large. Certainly under like Gensler's SEC with regard to how crypto was handled. But even if you just look at some of what happened with Dodd-Frank and sort of the brouhaha around swaps and who governs security-based swaps and where's the dividing line and how do we have coherent frameworks for these, some of these even remain unanswered to this day. Like, I will remind everybody, there was a stable value study that was supposed to be completed by 2011 that still is literally not complete, partially because of these coordination issues between the regulators. I'll also say, speaking to Chris's point, I think what's important for our regulators, and it's something we failed at recently in the United States, is having independent, thoughtful regulators who are going to listen to all sides on an issue. And I think Mike is one of those people, knowing him personally. You want the critics in the room, specifically the informed critics, right? Like, not the hysterical sky is falling, using the internet will kill us all. But there are many deep critiques of this space. Joseph, I think you've had some of them about some chains in the past. And on the other hand, I think we need the proponents in the room, and we need to get to a good outcome. And thus, we really do need the SEC and CFTC at least talking with each other respectfully. They don't always have to agree, but they need to be willing to communicate.
Yeah, no, agree with all the takes. I mean, these issues are legitimately difficult. How do you classify these assets? What's the taxonomy? They have traits sometimes of derivatives or securities. Ultimately, you need congressional action. And we have that coming also with Clarity Act. So I think the backdrop, back to where we started, is very constructive.
I believe it when I see it on the Clarity Act. I hope you're right.
Yeah, I think going back to Dodd-Frank, that's going to be incredibly difficult to get all of that right in one shot. But one, hopefully perfect is not the enemy of good. And two, if you can't do the whole thing, guys, there is the whole idea of breaking it up into parts and passing each one. So, all right, on that note, we have been rolling for an hour. So this is where I'm supposed to say thank you to my co-hosts, and especially thank you to Joseph Chalom for coming on. This has been fantastic.
Thank you, Joseph.
Really enjoyed it.
This was super fun. The most conversational podcast that I've been on in a very long time. So thanks for having me. I'd love to come back again.
Thank you, Joseph.
We look forward to it. So thanks for joining us on this episode of Bits and Bips. We'll be back in a week to discuss more about how the worlds of crypto and macro are colliding. Until then, take care, everyone. Ram, have fun in Vegas.